There is a little known kind of account which anyone who pays income tax can potentially benefit from. It's been out of favour for a long time but could now be making a comeback. So, investment bonds, are they boring or could they be beneficial? Well, I think the latter, and I want to tell you why. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK, and this video is brought to you by Meaningful Academy. More on that in a little bit. Now, investment bonds are often confused for other things. That word bond means just too many different things in personal finance. We're not talking about premium bonds. Those are tax-free savings accounts from NS&I. We're not talking about government or corporate bonds. Those are assets that produce an income and are usually held inside funds in your ISA or your pension. And we're not talking about deposit bonds. Those are fixed term deposit accounts with banks or building societies. No, we're talking about investment bonds, occasionally called insurance bonds. So what are they and why are they being considered again after being out of favour for quite a long time? Well, we're going to look at what they are, how they are taxed, what happens when you take money out, some use cases and a couple of weird anomalies, and I'll compare them with investing in an ordinary general investment account. So what is an investment bond? Well, it's really just another kind of wrapper. So like a pension or an ISA, an investment bond is a wrapper. It's used to hold investments, usually in the form of funds. What makes them special is that they are single premium, whole of life insurance policies. Say what now? Well, let me break that down for you because it's kind of meaningless language. Single premium, that means you set them up with a lump sum investment, not a regular monthly payment. Whole of life, that means they have no end date except the day that you die or when you surrender them. And the insurance policy bit, that really refers to the tax rules that investment bonds are written under. Investment bonds are often split into lots of miniature little policies called segments. So if you invest, say, £100,000, you might actually have 100 segments worth £1,000 each. And they're all kind of grouped together into one bond. And they do this to make tax planning potentially more flexible. Now, I always say that what makes one wrapper different from another, so what makes an ISA different from a pension and different from an investment bond, is two things: tax and access. Now, you can access an investment bond whenever, so we need to talk about tax on this occasion. And with an investment bond, you make an investment. Let's just say that's £50,000. In the policy is written an element of life insurance. It's usually 1% of the value at the date of death. So if you die straight after investing, that £50,000 would become £50,500. That's what would be paid out on death. If the value grows to £75,000, say, and you die, £75,750 would be paid out. And it's this little nominal 1% level of life insurance that means that these things get the tax advantages that they do. Now, an onshore investment bond is subject to UK corporation tax on any income or gains that the bond makes. And that taxation within the thing is deemed to satisfy the tax liability for a basic rate taxpayer, and that's important. If you are a basic rate taxpayer, when you take money out of a bond, chances are you won't pay any more tax. I'll give you an example in a little bit. You can withdraw up to 5% of the amount that you invest each year with no immediate tax implications. So if you invest £50,000, you can take £2,500 a year out. Also, those 5% can roll up. So if you don't take anything out in years 1, 2, and 3, you can take 20% out in year 4 with no tax implications. 4 lots of 5%. If you take out more than the 5%, or if you surrender the bond in full or in part, that's called a chargeable event. And it's then that tax is potentially payable. If you're a higher or additional rate taxpayer, so you're paying 40 or 45% income tax, well, you're paying less tax on money inside an investment bond than you might otherwise, because it's just notionally taxed at basic rate. Importantly, there is never any capital gains tax to pay within an investment bond. It just doesn't fall into the capital gains tax regime. So let's look at a very simple example of taking money out of a bond. Let's say you invest £50,000 and 10 years later it's worth £80,000. So you've made a 30 grand gain over 10 years and you haven't taken anything out of it as you've gone along. Now there's a relief called top slicing relief. So you divide the gain over the time in complete years that you've held the bond. So £30,000 divided by 10 years, your top slice is 3 grand. Now you add that £3,000 to your income, and let's say your income is £48,270. Well, when you add the £3,000 top slice gain, you would go into the higher rate tax threshold by £1,000. Multiply the £1,000 figure back out by the 10 years, and that's your chargeable event figure, 10 grand. Basic rate is deemed to have been paid, remember, so it's only the difference between basic and higher rate tax that's got to be paid. That's 20%, so you'd have to pay 2 grand worth of income tax on the gain. Now, that is a very simplistic calculation. If you have an unused personal savings allowance, that can be used to reduce the tax payable. There are added complications if you have made previous withdrawals. It's slightly different again if you fully surrender the whole thing, or individual segments, or if you partially surrender parts of the bond. It's different if you have both dividends paying and a chargeable event in the same year. So there's complications, but I don't want to muddy the waters here. That very simple rule of thumb calculation that I just went through will do for now. But I will compare it with the capital gains tax example in a little bit. So this is all quite technical stuff, isn't it? So let's just have a breather. And while we do, let me ask you a favor. If this is useful, please do hit the like button on this video and subscribe to the channel if you're not already. We've just gone through 100,000 subscribers. See the little plaque there? That's just amazing. So thank you if you're one of those 100,000, and thank you if you're subscribing now for the first time. Also, if you want to understand more about building a portfolio, choosing the right tax wrappers, picking underlying funds, and what it's all going to add up to one day, check out Meaningful Academy Build Wealth. That's my online course that is really my most distilled learning on navigating the UK personal finance system and building wealth efficiently for you and your family. So head over to meaningfulacademy.com to find out more about that. And if you decide it's for you, use a coupon code YouTube to get a discount. Okay, let's head down for a little bit more on investment bonds. So what are some use cases for these things? Well, if you're a higher rate taxpayer looking to invest, and you know you're going to be a basic rate taxpayer down the line, then it might be a good idea because you'll pay a lower rate of tax now, and when you come to take money out later, you shouldn't have any higher rate tax to pay. Should go without saying, by the way, that pensions and ISAs come first, right? Those are much more tax efficient. Investment bonds don't technically produce an income, and that can make them quite useful in certain times of trust, because in a trust, income is very highly taxed. I've seen them used where you have a vulnerable beneficiary who has been left money inside a discretionary trust, and the investment doesn't interfere with any Social Security benefits that the beneficiary might get. The segmented nature of an investment bond means it's easy to assign parts of it to an individual. Perhaps you can do that in your will, and then the taxation calculations are completed on your beneficiaries, and that might be helpful. One little known wrinkle is that because these investment bonds are actually contracts of life insurance, they generally can't be factored into any financial assessment for long-term care. Now, that doesn't mean you should go out and put all your money into them if you're worried about care costs, because doing so would probably be deemed to be deprivation of assets. So that wouldn't play well with the local authority. Finally, one group of people who should definitely not have an investment bond are non-taxpayers. They would be paying more tax than they need to because of the bond paying the equivalent of basic rate tax within itself. Let's do a very quick comparison with the general investment account. So in our earlier example, we made 30 grand gain in a bond, and if our income was 48,270, we paid 2,000 quid in income tax on that gain. Now, if somebody with the same income made a gain of £30,000 in a general investment account, say, first we would take off the capital gains annual exempt allowance, which when I'm recording this is just £3,000. So now we have a taxable gain of £27,000. 2 grand of that gain would fall into the basic rate tax band, and so would be taxed at 10%. So that's £200 of tax. The other £25,000 of the gain would be taxed at 20%. So that's £5,000 of tax on that slice, making £5,200 of tax altogether, capital gains tax. And that's compared with the £2,000 tax bill paid by the investment bondholder. But much depends on your tax status, both as an investor and when you're likely to take money out. Just a couple of little exceptions here to finish things off. You can have offshore bonds. These are issued by insurance companies that are based off the UK mainland, in places like the Isle of Man or the Channel Islands. These bonds do not pay tax while they are growing. And that means that if you compare an offshore bond with an onshore version, the same amount invested should grow more quickly offshore. But of course, the investor then has to pay all the tax due on the withdrawal. There's no sort of basic rate tax has been paid. in that offshore version. And then there's something called capital redemption bonds, also usually held offshore, but it's a form of bond which doesn't have lives assured attached to it. So it's not technically life insurance, technically, but the point is that it doesn't end on death. Usually the end date is set sort of 90 or 99 years from inception. And these are useful for when you don't want the bond to be forced to end on the death of the investor. One way around that, of course, on a normal bond is to have 2 generations as lives assured. So the investor and maybe their child. And so assuming the child, adult child, dies second, it won't be forced to close when the investor dies. Okay, well done, folks. There was a lot of detail there, a lot of work to get through, but it's just impossible really to put together a definitive guide on these things. There's just too many wrinkles, and whether they're any good or not depends on you and your tax status and your future tax status. So tread carefully, particularly when you surrender a bond. Definitely seek professional advice, and also seek advice when you're taking them out too. They are complicated, but potentially useful in the right circumstances. Thanks for watching this video. Do like it and subscribe to the channel if you're not already. And while you're waiting for the next one, maybe check out this video. It's a lot simpler, I promise. I'll see you next time. Cheers.